All right, welcome back. The market is pretty wild right now for the week of April 6th, and that means volatility. So, today we're going to look at two option plays I'm really keen on. Plays designed to take that volatility and make it work for us. Let's jump in.
Okay, so first things first, let's look at the big picture. Right now, the VIX, the market's fear gauge, is up at 2387. Now, for us option sellers, that's actually great news. Why? Because a high VIX pumps up the premiums we can collect. Basically, more fear in the market means more cash in our pocket up front.
So you see that high number, and you might think, is this dangerous or is this an opportunity? Well, for what we're doing today, we're looking at it as a clear opportunity. We're not trying to guess which way the market's going to go. Nope, we're just here to take advantage of those juicy premiums this uncertainty is creating for us.
And how are we going to do that? With my favorite tool for this kind of market, the sell-put strategy. Think of it like this. We're basically becoming the insurance company. We get paid cash, that's the premium, right now. And what's the catch? We just have to agree to buy a stock that we already like, but only if it falls to a price we think is a bargain anyway. And in a market this nervous, those upfront payments are a lot bigger.
All right, play number one. Let's get into it. This one's on MicroStrategy, that's ticker MSTR. Now, the setup here is super interesting. It's all about what the stock has been doing right after its big 10-for-1 split.
So why do I like this setup? Three big reasons. First, after all the chaos of the split, the stock has actually settled down and found a nice, stable base. Second, the price we're targeting gives us a solid 11.4% cushion from where it is today. That's a nice buffer. And third, just look at that implied volatility, 66%. That means time decay is our best friend here, just eating away at the option's value, which is exactly what we want as sellers.
Okay, let's talk brass tacks. For MSTR, we're looking at selling the April 17th put with a strike price of $110. For taking on that obligation, we're looking to collect anywhere from $3.15 to $3.50 per share. Now here's the most important part, the break-even. Even if the stock drops and we have to buy it, our actual cost would be down around $106.50. That's a much better price than where it's trading today.
Okay, on to play number two. This one is a totally different kind of setup. We're looking at SoFi Technologies, ticker SOFI. And with this one, it's all about one big thing coming up, their earnings report on April 29th.
So the whole game plan for SoFi is to cash in on all that pre-earnings hype. You know how it is. Nobody knows what they're going to report, and that uncertainty has cranked the implied volatility all the way up to 67%. So we sell the put now, grab that juicy premium while it's high, and then we sit back and wait for something called IV crush to happen right after they announce.
So what the heck is IV crush? It's actually pretty simple. Before earnings, there's tons of uncertainty, right? So options are expensive. The second the earnings numbers come out, all that uncertainty, poof, it's gone. The implied volatility just collapses. It gets crushed, and that makes the option premium plummet. For us, as sellers, a plummeting premium is pure profit. It's exactly what we're playing for.
All right, so here are the numbers for the SoFi trade. We're targeting the May 1st expiration at the 1450 strike. For that, we can probably collect between 85 cents and a full dollar per share. And check this out. The break-even is somewhere between 1350 and 1365. Why is that cool? Because that's a huge historical support level for this stock. So even our worst-case scenario has us buying at a really strong technical level.
So there you have it. Two really different plays, but both using the exact same strategy. Let's put them side by side so you can see the contrast really clearly.
And yeah, this lays it out perfectly. On one hand, you've got MSTR. That's a play on stability after a big event. It's a more expensive stock, and we're in it for a shorter time. On the other hand, you've got SoFi. That's a play on volatility before a big event. It's a cheaper stock, and we're giving it a bit more time to play out through earnings. See? Two totally different flavors, same core idea.
So, look, the real takeaway here isn't just about these two specific trades. It's about the thinking behind them. It's about understanding why one setup works here and why a different one works there. That's how you start finding these opportunities for yourself.
And that really brings us to the big question for you. What's your style? Do you like the idea of playing for stability after the dust has settled, like the MSTR trade? Or do you prefer the thrill of a pre-earnings play, riding that wave of volatility, like we're doing with SoFi? There's no right answer. It's all about what fits your strategy.
So there you go. Two totally different ways to tackle this volatile market. I hope this gives you some good food for thought for the week. Thanks so much for tuning in, and I'll catch you on the next one. Huat, ha!